Good afternoon, everyone. It's January 16th, 2016. In this week's video, we'll review the Spiders ETF, the USO, and we'll take a glance of the major sectors of the market to sort of get or gauge rather market sentiment and recent price activity. So we'll begin by taking a look at the weekly chart of the Spiders ETF. There isn't much bullish things to say about this week's price activity. If I had to find a silver lining, it's the fact that the S&P 500 closed 20 points or thereabout higher from this week's lows. But even so, the index closed below the midway point to this week's range. So that in itself speaks to the internal weakness of the market. The most point I see most problematic is the fact that the S&P 500 lost not only first and second order of support, but it ended the week below third and final order of support price between 189.30 and 189.79 S&P 500, which, as represented across space and time, coincides with the rising trend line that dates back to 2011. Even though a week, let alone a day, does not set a trend, we have to give, for now, the benefit of the doubt to the market bulls. There's this increasing probability that the midterm trend, which as I defined it, is a time frame between 12 to 36 months of potentially rolling over as bearish. If you remember, the first half of 2015, what really characterized price was a lack of direction. After the August breakdown, the short-term trend went from being sort of quasi-neutral to bearish. And right now, the short-term trend is clearly bearish, and now there's this possibility that the midterm trend also rolls over as bearish. That hasn't happened since the 2011 breakdown, when this whole government shutdown hysteria was going on. Back then it took some time to sort of repair those lower prices before markets pushed higher. In fact, it took 6 months once the midterm trend was confirmed as bearish. Took 6 months for the S&P to again consolidate at lower prices before pushing up against the current high, or the then former high. So that's basically what we're looking at here. If this midterm trend does in fact turn bearish, there's a very good probability that the first half of the year that we won't see any new highs in the index, and that as long as price holds current prices, we won't see any new highs even if it happens until the second half of 2016. What happens if the S&P 500 doesn't sort of reclaim this rising trend line? Well, initial support is found at 184.57. If that doesn't hold, then the next support band is priced between 178 and 180.57 spiders. If you are someone who basically avoided this last 2 weeks, right? You weren't either long or short. You were just sitting in cash, and you're just now thinking of participating, be it to a long side or to the short side. From a price to price, just from a price perspective alone, apple to apples, basically your risk to reward ratio is 1-to-1, because right now at current prices we have roughly 100 to 120 points in upside, right? A trade as high as 200 or the current pivot to the current to the established range, and then to the downside you also have about 100 120 points to the downside. So from that angle, you're not really being compensated to take on risk, again, from a price perspective alone. But again, I mean, if you're a market bull for next week, over the next few weeks, the ideal setup is for a back test of the rising trend line, where price not only closes at but slightly above this trend line, right? And then we need to see price sort of being accepted all throughout this trend line, and as high as 200, which is the current pivot to the established range. If for the next 2 to 4 weeks that happens, in other words, price is heavily exchanged between the rising trend line and 200, then you could, not only would the midterm trend not be considered bearish, but in time the short-term trend would also be roll over from being bearish to neutral, and then the probabilities of the current highs being contested sometime in the first half of 2016 as opposed to the second half of 2016 get that much bigger. Um, on the other hand, if over the next few weeks price is having a hard time getting accepted at the rising trend line, in other words, price does backtest the rising trend line but doesn't really sort of uh, close at or around the rising trend line, then again, the risk to the downside is another 100 points on the S&P 500 or thereabouts. What market pools would not want to see is a slingshot move like the one we saw in October of last year, in August of last year, and in October of 2014, where you essentially get a 2 to 4 week upside, violent upside move in the index, and then investors are essentially left with a choppy mess. That's not the ideal setup because, again, we've seen what that does. Um, so that's basically for the S&P 500. I mean, that's basically the bolts and notes of what I'm looking at. If you take a closer view of the index and take a look at the hourly chart, again, there's not much of a bullish undertone. But if I had to find a silver lining, it's the fact that, again, price closed off 20 points from its lows, and as of now, it's setting an inverse head and shoulders formation. I mean, based on the range of the of this formation, the S&P 500 has an additional 20 to 30 points in upside, which would put it around roughly 190 to 191, which is clearly above the rising trend line, right? The gap we got on Friday would only be partially filled, and that would suggest that either a new pivot, assuming the gap is partially filled, a new pivot would be created at the lower range, just as 200 served as the upper pivot to the established range. So next week is going to be important for the establishment of a new pivot if it's created. The current investment environment is toxic, and what I mean by that is that unless you adopt a day trader's mentality where you buy and sell a product during the same trading day, the market isn't rewarding you for taking on additional risk. In other words, the market is paying you to take on risk, obviously, but it's not paying you to speculate to take on risk, which is, I guess it's two different ways of viewing the market. Before, the market clearly paid you to take on additional risk, right? The speculative risk that I'm talking about. But now it's not doing so. The fact that before trends were being built after one another, again, what I mean by that is that effectively, if you bought, say, Apple at $50, you were more likely or not going to, someone was willing to buy Apple from you at 40, 53, 54, $55. And, that sort of fell on its, feeded on itself, and created this, the bull rally that we've come to see over the last few years. The fact that the market psychology has changed, not only changing to a seller's market, right? One where people more likely than not sell short the rips, right? Any bounce you get, and then sort of cover lower prices and rinse and repeat, does the same process over and over. Not only has that changed, but the attitude of how people do this has also changed. In other words, people are much more aggressive today, and they're after each other's throats, and that's basically why I'm calling this a toxic investment environment, because everyone's out to get everyone else. I mean, that's always the norm in the market, but today it's much more pronounced, and that's the biggest risk that I see, because again, it's not a risk that I can quantify, and it just sets up for a very nasty trading environment where, again, you have to be very quick, very nimble, and if you take overnight risk, unless you're lucky or understand the trends at hand very, very well, you're not going to get rewarded, because again, everyone is after the same sort of I guess prize, you can call it. But that's all I want to say about the spiders. So we'll leave it at that. If we look at the daily chart of the USO, again, there's nothing bullish to say about recent price action. Again, if I had to find a silver lining, it's the fact that this week's price range was fairly compressed as volume got exchanged, as there was an increase in volume, right? Usually that means, that's one of the many characteristics you have to have in place to have a bottom in place. So what I'm trying to say here is I'm not calling for a bottom right now in crude oil, but again, the fact that price remained in a fairly compressed trading range on higher volume indicates, for now at least, a bottom could be at place. The only way I would be interested in trading crude to the upside, even if it's for a day trade, again because of the current market environment, if it's crude trades above 911, 913, and that would essentially set up for a trade up to 10 and as high as 1015, but before you have to sort of reassess market conditions. But really, that's the only way I would be interested in trading the USO, even if it's just for a relief rally. If we take a look at some of the major sectors of the market, there's the XLI, I think, best sort of exhibits the current risk profile investors are asked to assume if they want to participate in the market. The reason I say this is because, here I label it a head and shoulders formation that's currently in effect, right? A good way to gauge market sentiment and where price may head in the near future is by looking at the XLI. The range of the current head and shoulders formation is about $5, right? So if you take the neckline, subtract the neckline, subtract $5 rather from the neckline, you get $47, roughly speaking. That's $1 or so below the 23.6 fib retracement shown over here. So, and before I actually say this, the 23.6 fib retracement is also coincides with the August lows. So if the August lows, right, if this fib retracement is taken out, and then price proceeds to also take out the $47 level, which is the measured target from this head and shoulders formation, that would undoubtedly set the XLI to trade down to the next sort of support found at the 38.2 fib retracement level at 41.73. If that happens, it's very likely that the S&P 500 trades down to at least the next sort of support, which I mentioned being 184.47. Or maybe as low as, again, 178 to 180.57, depending on how weak other sectors perform relative to the XLI. But that's basically, that's a good way if you want to look at a single indicator. Although I wouldn't recommend doing that, but if you want to do that, the XLI is sort of the one you want to pay close attention to. And it's also a sector you want to pay close attention to because it's sensitive to changes in interest rates, or not just interest rate policy, but also expectations surrounding a possible interest rate increase or cut. So I'll give you that sort of indication that's hidden from other sectors, or from most other sectors in the market. If you take a look at something like the XLK, it's showing some relative strength. In fact, unlike many other sectors, which I'll show you in a bit, it's trading well above the rising trend line that dates back to 2011. So here, even though the short-term trend is confirmed bearish, the mid-term trend is ways away from being considered bearish. That said, price closed below the 50% fib retracement to the established range. I mentioned last week how if you had some exposure to tech, a trade below the 50% fib retracement would either force you to cut back risk considerably, meaning cut your exposure by 80%, or just completely get out of the market until the fib retracement, this fib retracement, sort of got reclaimed within the next few weeks after the initial break. I still think that's a proper and prudent trade of approaching markets. So unless the tech sort of regains this price point, you have to be super cautious with what you're willing to buy within the technology space. As long, this over here, this is a time rate. If this time rate can serve as sort of short-term support as yet, XLK sort of, as market bulls try to overcome this current resistance band at 40.99 or there, or 40.09, excuse me, or thereabouts, then the XLK would be in okay shape. But again, it wouldn't lead me to believe that a bottom is in. We still need more information, and more importantly, it wouldn't indicate higher prices are going to be achieved fairly soon. It would just sort of halt the current decline. That's all it would do. If you look at a leading or a lagging sector like transports, again, the fact that the IYT closed below a time rate, a very important time rate, and before the trend line that dates back to 2011, again, speaks to the internal weakness, and it shows you again that there's buyers willing to accept price but at a much lower level, and that's sort of problematic because it's one of the characteristics of a bear market, price being accepted or only at lower prices. Notice that price basically found support between these two fib bands, 118.16, 119.43. So that's, you could expect at least for, yeah, the very least next week, for price to hold this price band. But it's going to be imperative for market bulls to sort of reclaim these two, this trend line and this time rate over the next week or two to really sort of negate any move lower in the ETF, and more importantly, again, sort of negate this possibility of a midterm trend being sort of rolling over from being neutral to bearish, or bullish to bearish rather. If you look at consumer staples, just as utilities, have held in there pretty well. In fact, they remain above their rising trend line that dates back to 2011. I hate to be so redundant and repetitive, but this is basically what I, and I'm sure many other investors, are sort of focusing in on over the next, and will focus over the next few days and weeks, because even though, most of you know, even though I don't rely much on trend lines because of their subjectivity, or because the subjectivity investors impart in these trend lines, I still have to focus and rely on them every now and then, because a lot of other people are, again, focusing on these trend lines. So it doesn't serve me any good if I just simply omit this from my analysis part of the markets, because it will affect market psychology and how different securities are priced. So again, I hate to be redundant, but it's part of the process, I guess. But in the case of the XLP, the fact that it's holding in relatively well, much better than most sectors, speaks to 2 points. First, obviously, internal strength within a weaker market, but more importantly, it's showing that investors are discounting the possibility, as of today, of the Fed possibly moving once in 2016, and that's it. Investors had expected the Fed to move on 3 or 4 times, as most economists predict the Fed will move this year. A sector like consumer staples or utilities, right, which are high-yielding sectors, they would have more likely not get crushed first, because people essentially gravitates away from dividend stocks and into growth stocks. So the fact that that hasn't happened shows me that investors are all not that convinced that the Fed can or will move by 3 or 4 times this year. They'll move again once maybe, and if there's enough pressure, they might even sort of backtrack what they did in December, and again sort of peg rates back at zero. If you utilities, again, I'll show you the same picture. It's a bearish or somewhat bullish trend that hasn't really deteriorated as of yet. If you look at something like consumer discretionary, which was sort of a market leader, it's now become a lagging sector, breaking below, again, the rising trend line that dates back to 2011. But here, notice that its price, even with the break below the rising trend line, it's holding above the 50% fib retracement mark of the current range. Again, ideally, market bulls will want to see a back test of this rising trend line while this 50% fib retracement level holds. But if we get a break below this 50% fib retracement on multiple but unsuccessful tests of this rising trend line, that you could use that as an additional sign of market weakness, and again, a bigger sort of rollover afoot. And that's basically all I wanted to say. I mean, that's sort of the major sectors I wanted to cover. I mean, actually, we can take a look at energy. Energy, again, continues. The problem with energy is actually threefold. The short-term trend is bearish. It's in a confirmed short-term trend. It's in a confirmed downward midterm trend. And right now, as of this week, it could potentially be in a confirmed long-term downtrend. This hasn't happened since 2008, 2009. Notice how, as of this week, the index closed below, or the ETF rather, closed below the rising trend line that dates back to 2002. So similar to the sectors I just showed you, where the midterm trend is in question, here, if $56 or thereabouts doesn't hold over the next few weeks, then that would again mean that energy is in a confirmed long-term downtrend. And even though, from my perspective, even though I think most of the carnage of the the carnage has been priced into commodity prices, if the XLE sort of remains in a confirmed long-term downtrend, that would mean prices are set to remain low within the commodity spectrum for longer than most of us anticipate. And again, sort of postpone any market highs, even if they're made, until the second half of 2016. It's impossible for the S&P 500 to make a new high when at least one of its sectors is in a confirmed long-term downtrend, and that's what we're facing essentially with the XLE. I was asked what's a good strategy if I'm sort of a contrarian investor and I'm looking for pockets of opportunity in energy. Look, everybody knows energy as a sector is beginning to get to valuations where it's beginning to look attractive. You know, most people, or you'll hear more often than not, that a high PE in the current cycle, right, in the cycle we're in today, that a high PE to the energy sector acts as a sign that the sector is sort of either fairly priced or overpriced to the S&P 500, and that's further from the truth. Actually, the higher the XLE trades, the higher the multiple the XLE trades at the current cycle, the cheaper it becomes. So don't get fooled into this thinking that because the XLE sells at a slight premium to something like the S&P 500 that it's expensive. It's not. And let's face it, most money managers understand that there's a lot of pockets of opportunity currently being made in the energy sector. You have to understand that not all names are created equal, and that not everything will rally when and if the rally comes about. Third, even in the most depressing and bearish of markets, a counter-trend rally of whatever amount takes place. The steeper the counter-trend rally within a bearish downtrend, the more powerful that downtrend is, right? If price sort of recuperates in an orderly fashion, then perhaps, and again, this is just one of the many signals you sort of have to look for, but perhaps a bottom of some sort could be placed. I'm not calling a bottom right now because we haven't seen any of that happen, but I'm just saying, looking into the future, that's sort of what you want to gauge. But I was asking, what's a good sort of strategy that I can implement where I don't run at much risk if I want to play a name that I find attractive in the energy space to the long side. And really, the best play is selling a put. If you find value in a company like Exxon or Chevron or Conoco, whatever it may be, right, because of a technical reason or a fundamental reason, whatever it may be, then you have to pick a spot or price where you think that security is not only offers tremendous upside, but offers value, right? And essentially a price where you're going to feel comfortable owning the stock. That's the first thing you have to do. So say in something like Chevron, you're comfortable at $80, then you sell the $80 put, and the worst that can happen is that you get assigned, or you get basically assume a position in the stock at around $80. $80 per whatever plus whatever premium you paid to enter the position, but you're essentially given a price where you feel comfortable from the very beginning of owning the stock, and that's really the worst that can happen. From there, you can micromanage your position depending on the trends, but that's really the best advice I can give you. But energy is still in a very weak state, short, mid, and long term. And again, until this long term uptrend is sort of reclaimed, you can't make the argument that energy is bottoming. You just can't. So that's really all I want to say about the markets. The last point before I finish this week's video is the following. I've heard and read recently that a lot of people are blaming the Fed for recent market volatility. Most people are saying that the Fed shouldn't have raised rates back in December, that they were too premature because current inflationary pressures are clearly sort of fading. Wage pressures, while to the upside, are likely to abate or even increase further, which will strain growth. And then, the others will point to the sort of cascading effect in price for some of these commodity prices as other reasons for the Fed sort of premature move to raise rates. I find this completely absurd and just wrong. First of all, you have to separate a, the impact sort of a rate increase has on the financial component and on the economic component of the trade. On the financial side, right, the biggest effect you'll see from a rate hike cycle is the initial rate hike. So the move from basically zero, it wasn't really zero. The fixed rate was always at 0.15, but the move essentially from 0 to a quarter of a percent is going to have the biggest effect or impact on the financial markets to begin with. Then future rate hikes, whether it be to a half a percent, three quarters of a percent, or whatever, have a diminishing effect or a diminishing impact on the financial side. And then again, on the economic side, a quarter of a percent rate increase is not going to affect the economy all that much. It's certainly not going to change consumer preferences. And again, the effect is so negligible that you're not going to have major shifts in secular trends that have been in place since 2008, 2009. So this argument that this quarter point rate hike by the Fed is the problem or one of the main problems to current market volatility is complete BS. We have to call it for what it is. If this argument is true and say the Fed has to backtrack its rate hike cycle, its quarter point rate hike, then if that's a solution, right, to current market volatility and it's likely to promote future growth, then why hasn't an era of 0% interest rates, for the last 7 years, why hasn't that A, sort of helped calm markets or market volatility, and B, why hasn't it sort of really led to higher growth rates, higher levels of productivity, a much or an improved jobs economy? And but obviously, what I mean by improved jobs economy, I mean an economy that actually produces long-term jobs and not part-time jobs for a select number of Americans, and so on and so forth. Obviously, as most of us know, the current readings of the job market are vastly jaded and they're not truly representative of what's going on out there. But if that's true, if if the Fed backtracking their initial sort of policy sort of verdict, if that's going to solve everything, then why hasn't it worked before? So again, these sort of commentary are not only are they nonsense, are they senile, but they don't have any meaning whatsoever. And I've said it all along. If you don't find anything of meaning that's truly going to of value, that's truly going to sort of impact in a positive way your investments, you shouldn't be listening to that. And that type of commentary for someone who either hasn't traded markets or bothered to sort of look at history, they're going to get trapped and they're going to believe that it makes sense, that it's true because it makes sense, at least on the seams of it, right? And it makes sense. I mean, but it doesn't. You have to dig deeper and you'll find the answer. And that's what I'm trying, that's the point I'm trying to get around here. If I make any sense whatsoever. But, just don't, I'm sure that this type of rhetoric is going to get much more pronounced over the next few days, weeks, and months. And believe me, there's going to be this pressure by interest groups for the Fed to want to sort of again backtrack what they did in December and push rates back to zero, even though again, from what I just said, the impact is negligible. It doesn't have that big of an impact. It's not the root cause, I can tell you that much, from what's going on right now. If you remember back in September or as early as August, investors were blaming the Fed's lack of action as the reason why markets were so volatile. Remember that back in August, people were sort of fed up with the Fed because the Fed didn't provide clarity as to when they would raise interest rates and what the trajectory, the path of future rate increases will look like. Once the Fed sort of satisfied both of those needs, both of those market needs, again, by raising rates and then sort of laying out a preliminary path for future rate hikes, for a week or two, the market sort of stayed mum and nothing happened, right? And now all of a sudden we're coming, hearing or reading or whatever, that this quarter point rate hike is the worst decision the Fed could have taken and it's a root cause for the current volatility. When again, it's just made up. It's BS. And this is the type of things that most of these people will use against you because they know you. Most of us, and I'm not excluding myself from this. Most of us don't know any better. Excuse me. And it's true. Most of the times we don't. But if we look at history, if we actually bother to research this, we'll know that it's complete BS what they're selling us most of the times. Again, I can't sort of harp more on this issue than I am today because it's extremely important to how well or not you do in the future. Okay, so that's really all I want to say about this. Be careful, remain nimble, be proactive, and micromanage your positions as you see fit. Unfortunately, you have to adopt the stay trader's mentality, even though it doesn't really add any value to the market. And what I mean by that is that besides not adding any sort of value day to day, right, is that this day trader's mentality is actually, if you want to talk about one of the root causes for current market volatility, the day trader's mentality most people are having to assume these days is the root cause for the volatility. Because think about it, if most people have adopted this mentality where they buy and sell positions in the same day, you're essentially creating inventory. Overnight inventory is not as vast as you would expect, so it's easier for some of these bigger players to move the markets up or down as they see fit because again, the inventory is not there to sort of back price. If people had a different approach and approach the market from a swing trader's perspective, then overnight inventory wouldn't be marginalized, and you wouldn't have so much volatility. So again, what I'm trying to say is that even though you have to, the market is forcing you to adopt this day trader's mentality, or at least micromanage your positions in a much more proactive manner. That's really what's part of what's causing this market volatility. It's not obviously it's not all of it, but it is part of it. So remain nimble, remain proactive, um, and please, whatever you do, please do not trust markets. Okay. We'll see what next week brings, and we'll talk to you next week.